We're all GTOs and you're watching Taking Stock.
Counting down to the close, everyone. It's Tuesday, February 24th. This is Taking Stock, and I'm Kristen Scholler, live for you down here on the floor of the New York Stock Exchange. Lots of news moving markets. Today, we are just about to close the day in equity trade. And as of 12:01 a.m. this morning, the Trump administration officially activating Section 122, a bold legal pivot that bypasses the Supreme Court with a fresh 15% global surcharge. Yet instead of a sell-off, we're seeing a defiant rebound. The major averages in the green as beaten down software firms find their footing, helped by Anthropic's effort to reframe the AI threat as a partnership rather than a replacement. And the semi-space is leading the charge. That comes as AMD surges on news of a massive infrastructure tie-up with Meta. It is the perfect rebound rally, some say, before the main event. We're officially on NVIDIA Eve. Speaking of that main event, tomorrow Jensen Huang reveals the numbers that'll either validate the AI anti-bubble fears or ignite the next leg of this bull market. $250 billion in market cap is hanging on the guidance. And we've got Dale Smothers of RDS Wealth, Steve Beard of Covista, who you'll see on the podium in a moment, and Phil Rosen of Opening Bell Daily and Full Signal on deck. Let's take a look at the closing bell podium. Covista doing the honors on that closing bell podium. Markets officially closed for trade. You heard it with the gavel bang. Let's take a look at the tape. The S&P 500 ending the session higher by about 0.8%. The Dow Jones Industrial Average up about 0.8% or 370 points. The NYSE Composite higher by 0.7%. And the Russell 2000 up 1.2%. It's loud down here, so loud I'm almost losing my voice. But the good news is we're going to talk more about these markets, and I'm pleased now to be joined by Dale Smothers, founder and CEO of RDS Wealth. Dale, great to have you on the show remotely today. What do you make of today's market rally?
It's the constant struggle between the bears and the bulls. We've seen a rebound, in my opinion, that's going to continue after the earnings are announced with NVIDIA tomorrow. I think that this continues deep into the week. Kristen, I'm finding that the software is being bought back up. This dip that has been, in my opinion, an overreaction has been bought up, and I think the market's getting it right here to not overreact to places like, or people like Anthropic who are coming out. We're seeing this partnership instead of a replacement, which is exactly what you said. I like that analogy, and I think that continues deep into the week.
Is the bull market thesis still in place?
Certainly is. I think the end of the year we see the S&P 500 higher. You've got the midterm election that in itself gives us historic reason to believe it's going to be a volatile time. Between now and December 31st, I think it's higher, but it will certainly not be a straight line. It's going to be everything but. You're going to have a lot of volatility to come. NVIDIA is front and center. You said the main event. I think that in itself is going to tell us what the next 2 to 3 weeks are going to look like, especially if we consider the bull story, the bull market story for technology. NVIDIA is the load-bearing wall in that story.
How should investors, Dale, be navigating through tariffs? Of course, we saw the Supreme Court ruling late last week, and we saw President Donald Trump's response.
Yeah, I think the tariff announcement is likely to resurface. I think we're going to find the administration coming up with a new way to announce tariffs on countries that do not cooperate. Donald Trump has used this as a tool. You know, this tool has essentially been ripped out of his hand. He has other ways. I don't think that the Supreme Court specifically said that tariffs were illegal, Nicole. Instead, or Kristen, they basically were saying that this particular way that he brought tariffs to be was the illegal process to do things. So he is going to pivot. This administration's going to pivot. They're going to bring tariffs back into the picture. It's going to continue to be a tool. Now, if I'm wrong on that thesis, and instead the government has to repay these tariffs because they were collected illegally, that is likely going to act as a tailwind for the market, because you're going to essentially have a tax return for these corporations that have paid in all of this money. Now they're getting this money back. They've already figured out how to do more with less. And Kristen, that tax return is going to be put to work. I think that in itself could be a mess. The courts labeled it a mess logistically, but when the money actually arrives, if that's the case, I think you're going to see the tailwind for the market.
What are you advising your clients do in this market environment?
Yeah, right now, we like playing an equal weight, the other 493, and then buying dips on names, specifically like Amazon and Microsoft, as we've seen these dips appear. You know, there are a lot of heavy hitters, if you will, big traders that are considering trying to pick at Jensen Huang's announcement coming out tomorrow, and I'm sure there will be attacks on anything he says that's not just absolutely spectacular, to try and bid a name like NVIDIA lower even. In our belief, though, we've got a lot of these names that should be much higher than they are right now, software specifically, buying the dips out of the equal weight position. So, Kristen, we're essentially heavy RSP, an ETF that gives us equal exposure to the entire S&P 500. And as we see these dips appear, we're picking up positions out of RSP, and we're pulling money out of RSP and buying into these names going into the remainder of the year. We think that, again, the market finishes higher. Just be prepared for volatility.
All right, Dale Smothers, founder and CEO of RDS Wealth. Dale, thank you so much for joining us today on Taking Stock.
Thank you, Kristen.
Okay, everyone, let's take a walk. We're going to see the wonderful crowd here for Covista. Covista is actually going to be joining me a little bit later for an interview live down here on the trading floor. We got to talk some NYSE notables. These are stocks that have outperformed today. And believe it or not, yes, we are waiting NVIDIA earnings, but we see other companies reporting results too. And that certainly has had an impact when it comes to some of these share price moves, and some big share price gains, in fact, that we've seen. So we'll walk on over this way. I'm going to tell you eventually about Home Depot. I'm going to tell you about Keysight Technologies. Both of these, multi-billion-dollar companies when we look at their valuations. And we'll start with Home Depot. Solid day for Home Depot, outperforming the broader market. That stock ending the session up about 2%. The big box giant trading higher after surpassing fourth quarter expectations with an adjusted earnings per share of $2.72. Revenue did slip year on year, with investors cheering a 1.3% dividend hike and surprisingly stable demand in the pro ecosystem. Now, despite the new tariff uncertainty weighing on the sector, the street is looking at the company's guidance as a sign of housing market resilience. All right, another big winner today. This one you might not have heard of. It's not as big as Home Depot, but it is still a multi-billion-dollar company. It's Keysight Technologies, ticker symbol KEYS, and it rose more than 23% in today's session. Catching a bid as a key tech-enabled play in an uncertain macro environment. Up after a recent trading update highlighting a 10% jump in revenue per principal. Now, as markets rotate out of some traditional software models, Keysight is benefiting from its unique platform as a service recruitment mode, which saw fee earners climb over 13%, and it's proving that quality recurring revenue still does have a place in the modern tech portfolio. You hear a lot about that recurring revenue and how important, of course, that can be, especially for some of these technology plays. So a great day for Keysight Technologies. All right, everyone, the action continues down here on the floor of the NYSE. And last week, the NYSE's Ashley Masternardi sat down with Hagerty CEO McKeel Hagerty to discuss sweet buys for collectible cars this year. Let's take a look.
NYSE listed Hagerty specializes in insuring classic cars, and they're in New York City, to reveal their 2026 bull market list, essentially the cars to watch. Joining me now is Hagerty CEO McKeel Hagerty. Welcome to the New York Stock Exchange.
Thanks for having me. Good to be back.
This business launched in 1984. It is a family business. You have been involved in the business full time for 30 years. Can you take me through the evolution of Hagerty?
It started as a, literally a retirement business for my parents who had been in the insurance business prior. And they knew that there were these little niches in the insurance world where there was a lot of passion. And wherever there's a lot of passion, that means there's better risk from an insurance standpoint. And it started off actually insuring a tiny little niche of wooden boats, classic wooden boats. Not a lot of people would even think about that as an insurance opportunity. And then it evolved mostly into what was used to be called the classic car space or the collector car space. And now we look at it as this bigger enthusiast vehicle category, which is cars that people want to own. They own because they love them, because they're drivers. They love that whole aspect of driving and owning cool cars and the community around it. So it's been an amazing few decades, and we've been 4 years here listed on the New York Stock Exchange, and I'm having a lot of fun playing with cars.
How large is the classic car market?
It's larger than people think. So when we look at the collector car market, just looking at the US, it's over 35 million vehicles in our kind of target category. And these are cars right now that are registered and that are extra cars in people's households. And they have some other characteristic that makes them interesting. Usually what that means is the values are going up over time rather than, you buy a new car and it kind of goes down in value. These kind of collectible cars, they're going up, and that's our world. And we surround them with insurance. We have our membership offering, which we call Hagerty Drivers Club. And now we have an auction company where we help people buy and sell these cars. So it's a whole ecosystem that kind of works together. And it's a bigger world than a lot of people think.
Is there a specific profile of a classic car collector?
Car collectors, they tend to be in the middle of their life where they have a little bit of discretionary income, and they tend to own their home. They tend to have regular daily driven cars that they drive on a daily basis for a transportation standpoint. And then, they're feeling good about things and they want to go buy that special car that they drive on a sunny Sunday afternoon or for some kind of pleasure purpose. And that's our world. And this pattern of people buying cars like this has been going on for decades. Actually, almost 100 years people have been collecting cars. So it's a long tradition. It's a bigger world than people think. And contrary to popular belief, the next generation is getting into collecting cars. And that's why we published this bull market list, which is to look at not just, okay, what are the cars on the rise, but what are the cars that the next generation is looking at and paying attention to.
That's right. You just launched the 2026 bull market list, essentially the cars to watch. What cars made the cut and why?
It's 11 cars on the list, and they're in different categories. So there's always some iconic sort of higher value cars on the list. And this year it's the Porsche Carrera GT, which was a car built in the early 2000s. Very high performance, kind of the last analog, a purely analog high performance car. And of course, Porsche is a brand that's been on the rise for the last 10 years. Then there's this whole list of kind of drivers cars underneath that. So a really affordable example, which they made over 1.2 million of, is the Mazda Miata. The second series of them is now really on the rise. That's a car that was $10,000 for a long time, and now it's sort of mid-teens, $16,000, $17,000 car. The most collectible car in the world in the U.S. is the Corvette. And this year, the Corvette Z06, the C6 Z06, which is a really high performance variant, made the list. BMW M5, another, again, kind of driver, fun, performance car, kind of the high watermark of BMWs. But then there's another big trend underneath here that we've been watching for a few years, which is kind of trucks and SUVs. We know that, today, modern drivers are often buying trucks and SUVs as their daily use vehicle. And the vintage variants of those are really starting to show that collectability. So this year we have a really high performance Chevrolet pickup truck. There's a Dodge Ram Charger, which was kind of like the Dodge version of a Ford Bronco, and Broncos have been really popular lately. And then kind of finally rounding out the list, we always sort of look at earlier kind of vintage classic cars and say, okay, what are the cars that maybe are more like their parents' cars or their grandparents' cars? What are those that are starting to show interest for this next generation? And this year, the team picked the Continental Mark II, which is a really cool 50s stylish going out to dinner car.
All right, McKeel Hagerty from Hagerty, thank you so much for joining us.
Thanks for having me.
All right. right, everyone, welcome back to Taking Stock, live down here on the floor of the New York Stock Exchange. I'm pleased now to be joined by the man that you saw on the closing bell podium, Steve Beard, CEO of Covista. Steve, welcome, and welcome to the Stock Exchange, in fact.
Thank you. Thank you for having me. It's a pleasure.
Of course, here to celebrate your Investor Day, a rebrand recently to Covista as well. What does it mean to do this at the NYSE?
Well, we've been traded on the exchange for a long, long time. It's the perfect place to celebrate the new name and new ticker symbol, and the perfect place to culminate our Investor Day where we announced a new growth strategy.
Talk to me about that growth strategy, how the company is going to evolve from here.
Yeah, so we're already the largest healthcare educator in the United States, but our goal is to become even bigger. There's a chronic workforce shortage in healthcare, and we think we're well positioned to address that at scale. So we've committed to going from 94,000 students to 120,000 students over the next 3 years, while delivering the kind of profitable growth that our shareholders deserve.
How does your purpose at scale strategy solve the clinician shortages that we really see across the country?
Yeah, two important ways. First, it's just by scale, providing more access to students who want to pursue these careers at a scale that no one else can. And second, it's by partnering with employers. We're going to do more to bring proprietary pipelines of clinical talent into hospitals and other provider settings. That too is an exciting part of the strategy.
How do you ensure that your graduates are prepared for an AI-enabled healthcare system one day?
Yeah, so we're actively partnering with technology giants like Google, like Hippocratic AI, GE Healthcare, to ensure that our graduates are AI fluent and prepared to use the tools that are going to be leveraged in the care environment.
And I see here just revealing an aggressive 3-year target, of course, through 2029. You talked about the growth strategy that you outlaid there. What are some of the primary drivers that you feel are going to set the company up for long-term profitability?
Yeah, so it's about bringing new market-responsive programs to market. It's about increasing the enrollments of the institutions we take to market today, and it's about getting employers involved and bringing more students to these professions.
Are your contracted workforce pipelines directly with health systems that the future, we'll see how that funding kind of sorts itself out?
Yeah, so we're piloting models where employers can actually be a part of the payer mix, get service commitments from the students, and get a stickier relationship with those clinicians as they come into their systems. We think it's a way to introduce a new talent acquisition model for healthcare providers.
What else do our viewers need to know about Covista?
Well, again, based in Chicago, largest healthcare educator in the world, #1 producer of nurses.
Wow.
9% of all nurses in the United States, 9% of all veterinarians in the United States, and more physicians than any MD school elsewhere in the U.S. It's a fantastic platform.
Just getting started?
Just getting started. Long way to go.
Steve Beard, great to have you in, and you made it in despite what's been a historic blizzard here earlier this week in NYC. Steve Beard is the CEO of Covista. Congratulations.
Thank you so much.
Yep. All right, everyone, stay with us. We're going to have much more Taking Stock after a short break. Welcome back, everyone, to Taking Stock. And today in startups raises and rounds, first up, we've got ChatGPT maker OpenAI teaming up with BCG, McKinsey, Accenture, and Capgemini to push enterprise AI from pilots to full-scale deployment. Up next, Claude maker Anthropic accusing Chinese AI firms DeepSeek, Moonshot, and Minimax of using fraudulent accounts to steal millions of prompts and train rival models. Finally here, speaking of OpenAI and Anthropic, TechCrunch reporting dozens of OpenAI investors are also backing Anthropic as record-breaking AI rounds blur traditional venture capital lines. All right, well, joining me now with more, especially on this AI trade, is Phil Rosen. He's co-founder of Opening Bell Daily and host of Full Signal. Phil, welcome to the program.
Thank you for having me.
Good to see you as always, a regular, of course, for our viewers watching. Let's take a step back and tell me about this report that here has rocked markets the past few days.
So on Sunday afternoon, Citrini Research came out with a unbelievable, essentially fictional report from the future. It's probably the first time ever economic data from the future has moved markets today. And it laid out a bear case on AI, but really it's AI got so good in this hypothetical scenario that it became bearish for the economy, for markets, for the labor market. And this freaked people out so much that we saw billions and billions of dollars in market cap wiped out on Monday. You saw software sell off, financials, a bunch of other sectors. And today we've bounced back, right? I think that knee-jerk reaction we've gotten accustomed to in the first couple months of the year. But this report was so compelling and so well written that investors took it pretty seriously. I, for one, I read it and I was like, wow, this is a great read. It's certainly entertaining and very interesting as a thought experiment, but it tilted a bit bearish for me. It's an amazing tail risk to think about. The idea that if you're bullish on AI, you have to be bearish on the macro. I'm not sure if that's exactly going to be how it plays out, but I thought it was an amazing report that apparently Wall Street really paid attention to.
Has it tangibly shifted the AI narrative?
That is a good question. We'll probably be able to look back on this report in a few months and say, remember the Citrini report. It'll be like the DeepSeek moment of last year. There's going to be the DeepSeek, the Citrini report, and I don't know if that really changes the trajectory of either the technology or the investment thesis for the AI trade. Right now, the risks in AI are the overspending, that it becomes so proficient as a technology that industries start becoming obsolete. I think we're going to land somewhere in the middle. I don't think we're in a bubble. I've been saying that for a year, and suddenly the pendulum has gone way away from the bubble fears, and now it really is fears that AI is so amazing that we have to turn bearish.
So let's talk about productivity and the impact here, right? Because we have heard top executives say that they're going to use AI to be more productive, and there have been questions about what that means for the workforce. Where do you stand on this productivity paradox?
It makes sense if you say, look, if I can manage 5 or 8 AI agents, maybe I don't need to hire as much if you're a business owner. But then on the other side, if you're looking for a job, you might see fewer job openings, and that means maybe a smaller labor market. Over time, we could see new jobs come up because every technological revolution creates new industries, new jobs, new opportunities, especially for young people and entrepreneurs. So I'm optimistic about that. Productivity, I know in my own life, I certainly see things I can do that I couldn't do 2 years ago, that I can do today with these new tools. And one of the fake or hypothetical economic data points in this Citrini report, I think it opened with something like the unemployment rate has spiked to 10% or something like that. And that was this hypothetical, okay, everyone has gotten so productive that we just need fewer people in the labor force. So that's something to watch. I don't think we're going to get to that extreme of a level, but that's what moved the market.
Where do valuations stand today for this trade?
Valuations are probably on a knife's edge because hundreds of billions of dollars can swing on a substack, right? So maybe we're one substack away from going back to AI bubble fears. Who knows? I think the knee-jerk reaction in markets right now shows how sensitive investors are to any fluctuations in the AI narrative. So we can get super bullish, we can get super bearish, and valuations will swing so dramatically that you have trillion-dollar companies that are essentially making meme stock moves. And that's very unusual. That's probably going to stick around for a while. This volatility is going to persist probably all year. But I would say that's where we're at.
Okay, well, watching those NVIDIA results that we get tomorrow after the close as well. Phil Rosen, he's co-founder of Opening Bell Daily, host of Full Signal. Always good to see you.
Thank you for having me.
Thanks, Phil. All right, everyone. We are going to, it looks like, maybe take a little bit of a break here. Stay with us. We'll have more Taking Stock on the other side. All right, everyone, time now for a few fintech, crypto, and AI headlines. First up, the crypto majors of Bitcoin, Ethereum, and Solana held steady today, only moving fractionally after an extended sell-off. Next up, Meta deploying 6 gigawatts of AMD-powered data center capacity over 5 years, a multi-billion-dollar per gigawatt deal that also gives Meta warrants for 160 million AMD shares. Lastly here, Bloomberg Intelligence says pending U.S. crypto law could multiply Coinbase's USDC revenue depending on how Congress handles stablecoin yield restrictions. Well, speaking of stablecoins, Money 2020's Scarlett Sieber is back with Jargon Translator, putting fintech terminology into language we can all understand. Let's take a look.
Welcome back. I'm Scarlett Sieber from Money 2020, and this is Jargon Translator, where we turn finance speak into plain speak. Today's term, stablecoin. Sounds chill, but it's the backbone of crypto. Picture this, you're deep in the crypto world. Price is swinging like a TikTok trend. Up today, down tomorrow. You need something steady. Enter stablecoins. Stablecoins are digital tokens pegged to real-world assets, usually the US dollar. So while Bitcoin is out here living its best roller coaster life, stablecoins stay, well, stable. Why does this matter? Because they're the glue holding the crypto economy together. Traders use them to park money during volatility. DeFi platforms use them for lending, and some people even use them for everyday payments. But here's the twist. Not all stablecoins are created equal. Some are backed by actual dollars in a bank. Others, algorithms and vibes. And when those vibes fell, well, Terra Luna crash. So next time you hear stablecoin, think less boring and more essential. It's the calm in the crypto storm. And that is your jargon translated. Back over to you.
All right, everyone, tomorrow on Wall Street, another big day. Of course, we'll be watching how these markets trade ahead of NVIDIA results. Plus, you want to tune into NYSE Live tomorrow morning at 9 a.m. Eastern with Ashley Masternardi. Market Movers with Remy Blair on FinTech TV. They'll be counting you down to the open. And that's just going to about do it for our show. Of course, we had a lot to cover. All eyes still on these software plays, on the AI trade. And we'll be doing it same time, same place tomorrow. Have a great evening.
Woo! Woo!